On July 20, 2020, a company whose engines had been running in driveways and backyards across the country for generations went dark on paper in a single afternoon. The New York Stock Exchange suspended trading in its shares and started the paperwork to remove it from the board entirely. Briggs and Stratton, the name behind small engines millions of people never thought twice about, filed for bankruptcy protection the same day. But the story that followed was not one of fraud uncovered or executives caught hiding losses. No indictment ever came. What collapsed here was not honesty. It was time. The company simply ran out of days to pay what it owed, and no one had lied about the clock. On that same July afternoon, in a Missouri courtroom, the company signed away control of nearly everything it owned to a private equity firm called KPS Capital Partners, agreeing to a $550 million sale of assets before a single dollar had even changed hands. It was the kind of quiet, procedural moment that rarely makes headlines, yet it marked the end of a business that had outlasted 2 world wars, a dozen recessions, and 100 years of lawn seasons. What follows is the story of how a debt maturity date, a pandemic-driven collapse in demand, and a financing structure built for decades of steady growth combined to force one of the most familiar names in American hardware into a courtroom and out the other side as someone else's company. Before the filing, Briggs and Stratton looked, on paper, like a business built to survive almost anything. In fiscal year 2019, the company reported net revenue of nearly $1.837 billion, carried $194.969 million in long-term debt, and held $446.720 million in shareholder equity. Numbers that read like stability, not danger. Factories kept shipping engines for lawn mowers, generators, and pressure washers to dealers across the country, the same rhythm the company had followed for generations. Then early 2020 arrived, and the rhythm broke. In the fiscal third quarter, ended March 29, 2020, net sales fell 18.4% compared with the prior quarter, as dealers stopped ordering and factories slowed output in the opening weeks of the pandemic shutdowns. Warehouses that were built to empty out every spring stayed full. Retailers that normally restocked shelves in April held back orders. Uncertain whether stores would even stay open. Inside the company, the numbers on the balance sheet that had looked manageable a year earlier started to look like a countdown. Todd Teske, the company's chairman, president, and chief executive at the time, later described the decision that followed as a difficult, but necessary and appropriate path to protect the business, language that suggested a company managing a crisis, not one hiding one. According to the financial advisory firm that later helped guide the company's restructuring, 3 obligations sat at the center of the pressure building underneath the business. A revolving line of credit used to fund everyday working capital, unsecured notes worth close to $195 million due in December of that year, and a pension liability that had never been fully funded. Together, the same advisory analysis found those 3 obligations added up to nearly $1 billion, a figure that dwarfed the cash the company could realistically generate once sales slowed. None of this was secret. What changed in the spring of 2020 was not the size of the debt. It was the amount of cash coming in the door to service it. Through the early summer of 2020, executives and lenders worked through what options remained. Refinancing the notes coming due in December looked less realistic with each passing week, as credit markets tightened around companies whose sales had just fallen by nearly a fifth in a single quarter. According to market analysis published around the time of the filing, though not confirmed in court documents reviewed for this account, a springing maturity provision tied to the company's asset-based loans added pressure of its own, tightening repayment timelines even before the December notes came due. What is confirmed is the deal that emerged from those negotiations. Briggs and Stratton reached an agreement with KPS Capital Partners, under which KPS would serve as the lead bidder in a court-supervised sale of nearly all the company's assets, at a purchase price of $550 million in cash. To keep the business running through the sale process, the company arranged $677.5 million in debtor-in-possession financing, $265 million committed by KPS itself, structured as a first-in, last-out tranche, and the remaining $412.5 million provided by the company's existing group of asset-based lenders. The structure told its own story. The people willing to keep the lights on during the bankruptcy were largely the same lenders who already held claims against the company, plus the buyer waiting to take over once the case closed. On July 20, 2020, that plan became public. Briggs and Stratton filed voluntary petitions for Chapter 11 protection in the United States Bankruptcy Court for the Eastern District of Missouri, the same day it announced the agreement with KPS. The filing confirmed what the numbers had already been suggesting since spring. The business could keep operating, but not under the ownership and debt structure it had carried into the year. The same day the bankruptcy filing became public, the New York Stock Exchange moved just as fast in the opposite direction, announcing it would suspend trading in Briggs and Stratton shares immediately and begin the process of removing the stock from its listings altogether. For a company whose ticker had traded on that exchange for decades, the suspension turned a financial restructuring into something visible to anyone watching a stock ticker, proof that whatever came out of the bankruptcy court, it would not be the same publicly traded company that walked in. Inside the courtroom, the process moved with unusual speed. According to the advisory firm that guided the restructuring, the entire case, from the initial filing to the closing of the sale, took just 63 days, managed almost entirely without anyone stepping into a physical courtroom, a reflection of how bankruptcy proceedings adapted during the pandemic. On September 15, 2020, the bankruptcy court formally approved the sale to KPS Capital Partners, authorizing the transaction under the Bankruptcy Code's process for selling a company's assets free of most prior claims against them. 6 days later, on September 21, 2020, the sellers completed the transactions spelled out in the purchase agreement, with the deal announced publicly the following day. What KPS received for its money was specific and deliberate. Substantially all of the company's assets, free and clear of most liens, claims, and encumbrances that had accumulated against them. The buyer was not purchasing a troubled public company with its debts attached. It was purchasing the machinery, the brand, the dealer relationships, and the workforce, without the balance sheet that had forced the sale in the first place. Public reporting at the time described the relaunched business as free of more than $900 million in obligations that had belonged to its predecessor. Obligations that simply stayed behind in the old corporate entity working its way through the bankruptcy process. For the people standing behind the secured lenders in line, the outcome looked very different. Trade publications covering the case reported that unsecured creditors were expected to recover somewhere between 7 and 10 cents on every dollar owed to them. An earlier market estimate, published before the sale closed, had put the figure closer to 7 to 8 cents. The exact number moved depending on when and who was counting, but the range itself told the more important story. For every dollar an unsecured creditor was owed, what came back was closer to a dime than to a dollar, if that. Common shareholders fared worse still. According to contemporaneous market analysis, the structure of the deal meant that operations would continue under new ownership, but existing shareholders would receive nothing, with the cash generated by the asset sale directed instead to creditors standing ahead of them in line. A description consistent with how this kind of asset sale under the Bankruptcy Code typically works, though it was not something confirmed in the court order itself as reviewed for this account. The stock that had gone dark on the exchange in July never came back to life. It simply ceased to represent anything at all. Even the executive who had led the company through its final years before the filing ended up standing in the same creditor line as everyone else. Todd Teske, the company's chairman and chief executive at the time of the bankruptcy, later filed a claim in the case seeking $11.6 million, tied to compensation he argued he was owed, placing him, procedurally, among the unsecured creditors expected to recover only a fraction of what they were owed, rather than as a defendant facing any accusation of wrongdoing. No criminal case, indictment, or enforcement action from securities or bankruptcy regulators followed the collapse. The record that survives shows a restructuring driven by debt and demand, not by concealment. For the dealers who had sold Briggs and Stratton engines for generations, the factories did not go dark the way the stock ticker had. Under the new ownership, the business kept building the same engines, filling the same warehouses, and shipping to many of the same retailers it had served before the filing. In that sense, nothing about daily operations looked like collapse at all. But underneath that continuity, an entire financial structure had been erased and rebuilt from nothing. The public company that had carried the Briggs and Stratton name onto the New York Stock Exchange for decades no longer existed in any meaningful sense. What survived was the brand, the machinery, and the workforce, repackaged inside a new, privately held company controlled by KPS Capital Partners, carrying none of the roughly $900 million in legacy obligations that had sunk its predecessor. Every shareholder who had held stock in the old company was left with paper that traded on nothing. Every unsecured creditor who was owed money by the old company settled, eventually, for cents on the dollar. The business went on. The people and institutions who had financed its previous decades did not go on with it. Leadership changed just as fast as ownership had. Steve Andrews was named president and chief executive of the newly formed company effective immediately after the sale closed, tasked with running a business that had just shed nearly $1 billion in obligations and needed to prove it could operate without them. Andrews stayed until July 2023, when he left the role for personal reasons, according to reporting at the time. Joe Liotine followed as chief executive that August, but lasted only 5 months in the position, leaving in February 2024 without a publicly disclosed reason. Christina Cerniglia, who had served as the company's chief financial officer since 2022, stepped in as interim chief executive at that point and was named permanent chief executive on July 31, 2024, putting a fourth different leader in charge of the reorganized company in under 4 years. That pattern of turnover said something about what actually happened during the bankruptcy, separate from anything written in the purchase agreement. A sale under the bankruptcy code can erase debt in a matter of weeks, but it cannot, on its own, erase the underlying pressures that made a business vulnerable in the first place. The financial reset gave the new company room to breathe. It did not guarantee it would use that room well, and the churn in the corner office over the following years suggested the company was still working out exactly how. The mechanics of who got paid, and in what order, illustrated the same lesson from another angle. The $677.5 million in financing that kept the company operating throughout the bankruptcy came due for repayment out of the sale proceeds, ensuring that KPS and the asset-based lenders who had funded the case recovered what they had put in. Secured lenders, whose loans were tied to specific collateral, were covered in full. The $550 million purchase price flowed through that same hierarchy, covering the most senior obligations first, and leaving progressively less for everyone standing further back in line. By the time unsecured note holders and pension obligations reached the front of that line, the sums remaining were measured in a handful of cents per dollar owed, not in dollars. The company that emerged carried the same name on its products, but very little else survived the crossing intact. Nowhere in the years since the sale closed did a criminal case, a regulatory indictment, or an enforcement action attach itself to any of the executives who led Briggs and Stratton through the collapse. Todd Teske was not charged. Michael Saros of KPS Capital Partners, who became chairman of the new company's board, was not accused of wrongdoing. The story that the public record supports is one of a business that took on obligations it could carry in good years, and could not carry through a pandemic-driven collapse in demand, not one built on hidden fraud that later came to light. The collapse of Briggs and Stratton as a corporate entity offers a mechanism worth remembering, separate from any judgment about the people who ran it. A business does not need to be lied to or lied about to disappear from public markets. It can be run largely as reported, generate real revenue, employ real workers, and still reach a point where the calendar of debt payments no longer matches the calendar of cash coming in. And once that mismatch becomes visible to lenders, the options narrow very quickly to a court-supervised sale. That kind of sale, structured the way this transaction was structured, tends to protect the parts of a business that a buyer wants and to leave behind the parts that a buyer does not. Machinery, brand recognition, dealer networks, and employees can cross over into a new company relatively intact. Debt, pension shortfalls, and shareholder equity generally do not make that crossing at all. For anyone holding stock or unsecured claims against a company heading into this kind of process, the practical lesson is blunt. A business surviving in name and in daily operation is not the same thing as an investment surviving alongside it. The other lesson sits in the timing. The pressures that forced Briggs and Stratton into court had been visible for years in its public filings. The debt load, the pension gap, the maturity dates approaching on the calendar. What turned a manageable set of obligations into an unmanageable one was a sudden, external shock to demand, arriving at almost the exact moment several of those obligations were coming due. Companies carrying debt loads built for steady years rarely have much room left when a bad year and a bad month arrive at the same time. Nothing about this case involved a hidden scheme brought into the light by investigators. No indictment followed it, and none of the executives connected to it faced criminal charges tied to the collapse. What the record shows instead is closer to a structural failure than a moral one. A century-old manufacturer whose debt schedule and demand curve stopped aligning, resolved through a legal process built exactly for that situation, at the cost of nearly everyone who was not standing at the front of the line when the money ran out. Disclaimer: this program makes no allegation of criminal or civil wrongdoing against any person named. Public records and reporting reviewed for this account show no indictment, criminal charge, or regulatory enforcement action against Todd Teske, Michael Saros, Steve Andrews, Joe Liotine, or Christina Cerniglia in connection with the bankruptcy of Briggs and Stratton Corporation. The company's Chapter 11 filing and subsequent asset sale are described in the sources consulted as a financial and operational restructuring driven by debt maturities and a pandemic-related decline in demand, not as the result of fraud or misconduct. Any individual named in this program is presumed to have acted lawfully unless a court of competent jurisdiction has found otherwise.